A t-shirt and jeans, mac and cheese, oceans and sunsets. Some things in life are an obvious match, like RIAs and Schwab Advisor Services, the number one choice for independent advisors looking for a custodian who can help them go further. With all the wealth services, technology, and support an RIA firm needs, the difference is so obvious. It's Schwabvious. Find your match and learn why custody is just the beginning at schwabvious.com.
Hi, everyone, and welcome to the RIA Edge Podcast. This is, as you know, the podcast where I get the chance to talk to executives at wealth management firms around their business strategies, to find out how they're growing their firms, how they make the decisions they do to create sustainable, viable, professionally managed businesses, and not simply practices that waft seemingly ever upward on AUM appreciation. Today, we're speaking to Matt Regan. Matt is the president and CEO of Wealthcare Capital Management. We caught up with Matt at the recent RIA Edge West conference in Los Angeles, and just weeks after he announced the sale of the firm from their private equity backers to Sammons Financial, a large financial services firm based in Iowa. So Matt's been on both sides of the M&A table, and we speak quite a bit about that and what we can expect from Wealthcare under the new owners. Like I said, we spoke on the sidelines at the RIA Edge West conference, so please forgive the less than ideal audio quality, but I learned a lot talking with Matt, and I hope you do too. Thanks for agreeing to be here with us. I thought it was interesting for the folks who maybe don't know as much about Wealthcare. You want to just give us the background on the firm? I know there was just a recent transaction, but let's talk about that in a bit. But
Yeah, actually, the history of the firms is interesting because we began life back in '99 in Richmond, Virginia, as a software company. Actually, the guy that founded it, Dave Loper, delivered the first Monte Carlo-based, goals-based planning software into the market, which he called FinanceWare. He really created the idea of kind of bottom-up goals-based planning for individuals. He also, at the same time, founded a straight-ahead RIA that utilized the planning software, and he called that Wealthcare. He ran both of those businesses for about 10 years. And ultimately sold both the planning software and the RIA to a middle market private equity firm in Philadelphia called NewSpring. And NewSpring actually made a kind of a bold strategic pivot in about 2016, 2017, and de-emphasized the software sales in favor of going to market as a platform that supports independent advisors. And that's what we are today. So we do maintain the proprietary technology, which is our planning software, which is integrated completely with our investment framework, our TAMP, if you will, and also includes a implementation, trading, and rebalancing engine. So that piece of proprietary technology exists today. It's a differentiator for us in the marketplace. We call it our common operating platform. But we today support a couple of hundred advisors across the country. Manage about $10 billion on their behalf in our model-based investment solution. And we also, provide them middle and back office services to get them out of the non-revenue generating activities. So think billing, compliance, operations, trading, the investment solution. So we consider ourselves a true platform for supported independents, SEC registered RIA, about 35 home office employees supporting those 200 advisors.
Those 200 advisors largely 1099.
Yeah, that's the predominant business model at the moment.
Mm-hmm.
We began to recruit in the 1099 channel in 2017, 2018. When I arrived at the firm, those advisors own their business. They own their client relationships. They typically do business under their own brands. And we just help them to build enterprise value in their practice. I went to the board in 2022 and said, I think we ought to get into the very crowded and very expensive M&A business. And we began our direct business then. We've done 4 acquisitions, 2 of which were our own existing 1099 advisors. We have another LOI that we hope to complete by the end of the year, at which point we'll basically be $10 billion in AUM, and $1 billion of it will be in our direct channel or owned W-2 assets.
Okay.
And strategically, where we're going is to take that from 10% of the total AUM more towards a 50-50 type.
So this was a decision, and I don't know if it was a planned decision, but to get those relationships with advisors as 1099s, back office support platform, and kind of then move them into the channel or
That's clearly where we are right now.
Yeah.
I don't know that I was smart enough to come up with that
Okay.
a few years ago, but that's where we're going. Yeah, the low hanging fruit for us are those 1099 advisors, because we know them, we like them, and one of the reasons why we like the M&A space is we're delivering the exact same products and services to the advisors. So when we bring an advisor on as a 1099, we get them onto our paper, we put them into our investments, we train them up on our software, and we help them grow. That's the exact same thing we're doing in the M&A space. So that's why we actually think we're pretty good at it.
Mm-hmm. Mm-hmm. Is this largely an opportunity then for these 1099 advisors who are maybe retiring to monetize the practice? Is that a fair or?
Yeah, we actually, because of where we're positioned in the marketplace, we actually, our advisors skew a little bit younger than the industry. Average age of our hybrid advisor channel, our 1099 channel, is about 54, which is much lower than the average age in the industry. And the practices that we've purchased to this point, they're actually younger advisors. They do want to stick around. They want to continue to run their business, but they just don't like running the day-to-day of the business. One of the advisors that we purchased told me, if he never had to negotiate another E&O policy, it's a great deal for him. And, it's kind of cliche, and I've actually heard it from the stage at this conference, but not too many advisors get into the business to, handle payroll and negotiate contracts.
Sure.
They want to be around clients and they want to be helping people.
Yeah.
And so that's some of the motivation behind it.
And you think taking some of those responsibilities off their plate obviously is a growth accelerator in a way?
That's really what we preach. I've looked at all of the tools in the market that supposedly are going to give these advisors client referrals, whether they're, Zoe Financial or, the
Smart Asset.
I think. And those are just, in my opinion, very ineffective, particularly for an advisor that's very, very busy, doesn't have time to, follow leads, within a minute. So what I tell advisors is when they ask me how I'm going to help them grow, I say, look, the only thing I can tell you is I'll take all the stuff that's bogging you down, all the stuff that you're not generating revenue off, all the stuff you shouldn't be doing, picking stocks, billing clients, handling operations, God forbid, compliance. I'll take those all off of your desk, and you're going to have time to grow your business and do what you do. Get client referrals, talk to clients, grow your business.
And the acquisitions that you made, the four, how did you find those firms? I mean, obviously we talk a lot and hear about cultural matches and this kind of thing. You must have found people that were willing to buy into that.
Yeah, very much so. We run two kind of business development processes, right? One is the 1099 channel where we're recruiting advisors. So we play in traffic. We use third-party recruiters. We find out who's being displaced. If a firm is in the news and there are people that are looking for other alternatives, we want to be there with them. We're constantly talking to advisors in motion in the 1099 channel. Likewise, on the M&A side, we run our own, business development. We have a bank of emailers that are reaching out to advisors, on a consistent basis. We have a business development group that talks to advisors. But the beauty of it is that often the 1099 recruiting discussions flip over into the M&A channel, and vice versa. We'll be talking to an advisor about a W-2, and it's like, well, maybe not now. We don't want to sell now. But boy, sure like your offering, sure like the flexibility of your independence model. Maybe I'll join as a 1099. We'll get the business ready for an acquisition down the road, and you'll be the likely buyer.
Okay. So as you're making acquisitions, usually the 1099 group is your hunting ground. It's kind of brings it close.
That's where we start.
Yeah.
And look, that's just a process of making it known to the advisors. Mm-hmm. So we just had our advisor conference in Atlanta 2-3 weeks ago, and just making it known that if there is, interest in a true succession plan through the sale of the practice, or if they are interested in even a partial sale of the practice, that we stand ready to be that buyer. So once they know that, those conversations flow pretty naturally.
Obviously take some capital to do this. Is it unusual for a firm this size to have a business development in-house with the calling banks and this sort of thing?
Well, yeah, I get where you're going. So it's interesting. When we were owned by a private equity firm, which I mentioned, NewSpring owned us, we brought in a business development officer to handle the M&A because NewSpring was frankly just too busy with their own business to provide that service to us. Mm-hmm. You had mentioned, and it's a fact that in July, NewSpring sold the firm to Sammons, which is a large financial institution, actually a conglomerate based in the Midwest. Sammons is a $30 billion company with a very large, financial group and very, very deep pockets. What I told the advisors and my employees and the market is that we swapped out private equity for permanent capital. Okay. Sammons doesn't think in terms of quarters; they think in terms of years. Okay. And they've never sold anything they bought, so we feel like we've really found a home. But Sammons also is very interested in growing our business and growing their wealth management space, and so they're going to be willing investors in the business. So we will likely combine our M&A efforts within the broader Sammons organization to ensure that we have deal flow and we have plenty of conversations to follow up with them in the M&A world.
Okay, so the Sammons acquisition kind of accelerates this M&A trajectory, and that's what we're doing. And you're doing that just as folks are starting to question whether or not the pace of M&A and the valuations that are out there for firms can survive or last. You must have a view on where we are in the business cycle of RIA firms and.
Yeah. I mean, I do think I agree with the idea that we're still in the middle innings here, that this thing is nowhere near the end. I also agree that valuations are extremely high, and we need to be extremely disciplined about where we're purchasing practices. That being said, we're looking at a particular type of advisor to buy. If you think back to what I mentioned about our product and service offering, we don't need to buy an RIA that's $2 billion that has an investment team in place, a trading team in place, operations, a compliance officer. That's not a firm we can really help. We're looking a little bit further down market from that, the sub-billion-dollar firms, really the $500 billion help, where we can really help. Again, we can provide them the infrastructure, the common operating platform, and the services that they can help them grow. So that's a specific part of the market that I do feel some of the larger PE firms and the larger aggregators are moving off from.
Mm-hmm. Yeah, they don't pay a whole lot of attention to that 500 million below RIA.
It's hard to imagine, but for some of these large aggregators, a $500 million deal just doesn't move the needle.
Right. Amazing. Do you have a focus that you think about when you go into the M&A market? We talked a lot here at this conference about service expansion and how maybe some of the stuff that's driving some of the acquisitions is less about just gathering assets and more about, we need the skills that advisor has, or, this office does something different that we can bring to our other advisors. And that's strategically driving why they're making certain acquisitions. Do you guys fall into that camp, or where?
I think aspirationally, I can't say that we've really executed on that yet, but I do think the idea that you're finding talent, particularly G2 talent in some of your acquisitions that could be transferable across the organization is, it has to be part of the motivation behind these acquisitions. It's just so tough to find talent, on your own today, in the marketplace, that if you can acquire it, and you can repurpose it, or you can expand the responsibilities, I think that's got to be one of the motivations behind your M&A.
And what about service expansion then? I mean, this is one thing that we hear a lot about. Are you feeling that pressure, or your advisors feeling that pressure from clients to bring some of these services in-house? I'm thinking mostly like, tax planning, maybe even tax preparation. I don't know, estate planning, all the other.
We feeling that pressure. It's one of the things that I've tried to address over the past couple of years. And we've created what we call our strategic alliance partnerships. So we have partnerships with, for instance, the tax accounting group at Duane Morris, the large international law firm. So they offer tax planning, tax representation, advanced tax planning services to our advisors. We have a good relationship with CBS Brokerage out of Minneapolis, advanced insurance planning, case design. And both of those firms will sit side by side with the advisors and the clients to deliver that higher level of service, that service expansion you were talking about. Ultimately, one of the things that we do have going for us in that regard is another firm that Sammons owns in Minneapolis called North Rock Partners, is much more a holistic, high and ultra high net worth firm with tax planners and estate attorneys on staff. And we're going to find a way to work out how we can work with those resources as well.
Interesting. Sammons brings some other things to the table too, right? Largely an insurance firm. I think there would be insurance practice and some other things. They're trying to move obviously into wealth management. Do you think that part of their motivation is to eventually absorb you into a larger kind of Sammons wealth management conglomerate or whatever it might be?
No, I don't see it that way. I think the strategy as we're mapping it out right now is to stand Sammons Wealth Management up as a new vertical at Sammons.
Okay.
You're right; they have a massive annuity business. They own Midland National, American Life, North American Life. These are very large businesses. But the acquisition of Wealthcare and North Rock and Beacon Capital, which are the three firms that they purchased in the wealth space, this is not a distribution play for them. It's actually a hedge to hedge against the interest rate exposure that they have in that annuity business. They see the wealth management business as a true hedge against the interest rates that they have exposure to, because we're a fee-based business that grows with AUM. So I think you're going to see heavy investments in M&A in the wealth space, and the wealth management business, creep up over time to get to the scale of the insurance business that's there at Sammons.
You talk about this, accelerated maybe pace of M&A. That's you're going to be embarking upon with this this money, and the types of firms that you're looking for. When you're out there talking to advisors and looking at the kinds of firms that might be available, what are some of the things that you're looking at? I mean, we hear all the time now about organic growth being the coin of the realm, and everyone's looking for organic growth. At the same time, you mentioned that some of these tools that are available to implement that organic growth, the referral systems or the digital marketing stuff that's out there, maybe not always effective. How are you vetting these advisors in terms of what numbers are you looking at, and is organic growth important? Do they have to, is there a hurdle that they have to have met before they even get on your desk? I don't know.
Yeah, certainly. I mean, I think the three things that everybody that's in the M&A game is cautious of is, a lack of organic growth, a lack of diversification in the book. So if there's huge client concentration, that's a big black mark against you. And lastly, the demographics of the book. So those are the things that you kind of go in on the way in. Nobody wants to catch up on the knife. So, when we look at a firm, I go back to what I said a little bit earlier. The firms that we want to buy are the firms that we can really help. If we can't do anything for you, if you've got, the infrastructure in place and you've got a process and your own common operating platform and you don't need any of Wealthcare's services, I don't know that that's a particularly great fit for us. So we focused on the 100 to 500, and now we've increased that with the Sammons acquisition from 100 to, we'll go to $750 million, perhaps $1 billion if it's an appropriate firm. But we want to find SEC registered firms who do things right, who can take some value and grow with our help. So that's, it's a pretty specific approach to M&A, but I think it's one that allows us to source our deals on our own, keep disciplined about the multiples that we're willing to pay, and then deliver real value post-acquisition.
Are those multiples then maybe in some ways lower than some that are being thrown around out there? What is happening with valuations these days? I mean, where do you see them?
I think, look, there's two types of deals, and this is not a shot at investment bankers, but when these deals are banked, and they're brought to you by an investment bank, the fact of the matter is they're going to be much higher multiples. That's what the bankers do. They get you 33% more or whatever the number is, and they do a great job of it. So we've taken the approach that we're going to find, first of all, looking at our own 1099 channel, we're going to have a much, closer, approach to exclusivity there, although many advisors are being solicited. But if we can keep it on our 1099 channel and then generate our own deals organically, we feel that we could be disciplined around valuations. Everybody, look, we're happy to pay for a firm that's growing, that has a great book of business, and we'll go into double digits on multiples. But you're not going to see us paying mid-teens or some of these multiples that you hear in the place.
Okay, it sounds like your former private equity owner was a good partner to the firm. set you up well for that transit. Was it maybe a successful monetization there with the sale to Sammons? I guess that's encouraging.
Yeah.
We hear a lot of talk about, this whole entire PE thing is going to be a disaster for the entire industry. I suspect you don't feel that way given your experience, but how do you feel about the private equity money that is chasing around so many firms now?
Yeah, I think you're going to start to see, and I'll use the Sammons acquisition of Wealthcare as an example. Sammons is a new entrant to they're not private equity, right? They're actually an employee-owned, they're an ESOP. And they have a very strategic approach to why they're entering the wealth management business. I think you're going to see more strategic buyers rather than just capital partners coming into the space. But private equity is always going to be there. Private equity loves the RIA space because there's three distinct drivers of growth, right? I mean, the markets always go up. Your clients are always giving you more money. And, you're finding new clients all the time. There's not many businesses that have three distinct drivers of growth. That's why private equity loves our space. So they're not going anywhere. That being said, I don't know what the end game is for some of these. Some of these large aggregators, they took money from massive private equity firms at 25 times EBITDA. Do they think they're going to sell them for 30 times down the road? I don't know that can happen. So, my own thesis is that you're likely to see more new entrants, non-PE, into the space going forward.
Firms like Sammons or others like that.
Yeah.
Okay. Interesting. You bring firms in, you say that, you want to find the firms that you can help, that are open to what you bring to the table. In that range of $250 to $700 million RIA, obviously there's, if they're trying to do the operations themselves, I see how that's a burden. But other than that, what are they lacking? What do most advisors, what are they missing? What do they need to
Well, the game's really changed, and we see this, you see this on the 1099 side too. Three of the larger firms that we brought in last year were existing RIAs, SEC registered RIAs, that shut down their registrations and joined us. And they did that because the complexity, the expense, and the regulatory burden of running a $150 or $200 million RIA has just become overwhelming to them. I use the example that we had an SEC audit a year and a half ago, 99 questions. They were all on cybersecurity. Now, if you're running a $150 million RIA and the SEC comes in with something like that, you're going to be dead in the water for months. It's just not something that you can handle. So the beauty of it is when we recruited these three firms over who were existing RIAs, they keep their brand, they maintain their client relationships. Ultimately, they didn't lose any clients, and they felt like they still own their businesses because they do. On the other side, when we're doing the M&A, it's a similar story. We're running into advisors that are saying, the cybersecurity, the insurance, the complexity, it's just gotten to be too much. I don't know what the number is where you shouldn't have your own RIA, but I can tell you it's higher than it was 10 years ago. And so I think that's some of the opportunities out there.
We were talking about the complexity of running some of these firms, and the money that's needed to do it. And you were talking about the hunt for talent and the difficulty of finding talent, which comes around to the compensation question. Particularly for your W-2 employees, how are you designing compensation for advisors?
So what we do is, typically in a deal, we'll do, a chunk of money up front. And then on the first anniversary, another payment based upon client retention. On the second anniversary, another payment based upon growth of the business, which gives the advisors a chance to earn a couple more turns on the EBITDA that they sold. Then the question becomes, what do you do after that? Then they're W-2 employees. They've got a nice check in their pocket. They've got the Wealthcare infrastructure in place at that point. And moving forward, what we simply do is we create a compensation pool based upon the revenue of the office. So we treat these as distinct departments. We say you're generating $2 million worth of revenue. Here's a 35-40% compensation pool. That's for you to divvy up to pay the people to run the business. You want to do it all yourself and keep all the money, that's fine. You want to hire an army of assistants and people around you, that's fine too. But it's coming out of the same compensation pool. Okay. So that's the way to think about it.
So in like any other kind of a large business, you're leaving the P&L decisions to the folks who are running those divisions.
We meet, generally quarterly with the the advisors that are W-2. We set budgets annually. We have checkpoints on a regular basis. And if they need things, they need to move into a new office. They need to hire some people. We're happy to have the discussion. These are businesses, thankfully the businesses that we've bought have had, very nice profit margins. And we keep an eye on that. We want to make sure that the deals, remain good into the future. But if they need investment, we're happy to make that investment.
Yeah. One of the things that I'm still a little confused about is and maybe you can help me clear it up, the amount of equity that the firms are giving to advisors that are coming in. Mm-hmm. And I don't know if it's in lieu of actual money, but equity in the infrastructure that they're bringing to it's like, you're going to join us and you're going to have a part of this whole thing that we're building. Right. And how long can that go before, particularly if it's PE backed, where does that end up? I mean, I've been a part of companies in the past where, we've gotten shares in the privately held company and never went anywhere, never did anything with them. There was no market for it. We never, came of anything. Is that what's happening here, or are we in danger of some of that?
Yeah, I think your instincts across the industry are probably right, that there is a risk to that. We're in a little bit of a different situation. When we buy a firm, they become W-2 employees, mm-hmm. and therefore become ESOP owners within Sammons. So just by dint of being an employee, you are an owner of Sammons. Mm-hmm. So there is that piece. But we also have created a synthetic equity program that we use. And what we do is, if it's part of the purchase price or if it's part of a retention package for staff for a firm that we've bought, we can give them grants of synthetic equity. It's cost. It's a real cost to us. So we have to include that as part of the deal cost. But that equity is tied to the increasing value of Wealthcare over time, hopefully. Mm-hmm. So, our business unit, Wealthcare, that the RIA, runs separately under its own brand at Sammons, and will be valued each year. And the equity grant that we've given these advisors and their employees actually have annual liquidity, so they can cash out along the way. And typically, the equity grant lasts for 5 to 7 years, so there's termination.
And in the synthetic equity equation, that cash payout annual is based upon the performance of the company. It's variable,
yes.
Based on the performance of the company.
Based on the performance of Wealthcare.
Mm-hmm. Yeah. And are all compensation structures designed that way? Because I feel like there's and I'm not actually speak specifically about your firm or any firm in particular, but I believe there's a lot of folks who believe they have equity in this large enterprise that they've joined, and we maybe disappointed to find that there's no market.
Yeah, I think there's a million different variations on it. I've heard some interesting ones at this conference, which I think really make a ton of sense. I assumed, listening to some of these large firms that have taken, big PE checks, that the PE firm always had majority control of it. What I'm hearing is that actually some of these firms, and I think it's a brilliant approach, the employees retain majority ownership, and the PE have a minority stake. I think that's a really great structure, because in that sense, then you really do have ownership in something, as the majority owner. It's not a scenario where, unless things go really bad, where you're going to get crammed down, or else they're going to change move the cheese on you. So mm-hmm. I do like that structure, but I think your instincts are right. I think there's, just a myriad of different approaches out there. Some are probably bulletproof, and some may not be.
Mm-hmm. Do you see in the changing economic landscape a slowdown in M&A? We haven't seen it yet, right? It seems to be continuing, and probably follows the markets too, as the markets go. Some folks thinking this is all sort of an inflated bubble. Do you see the pace continuing, or are we in danger of kind of getting over the skis? And you've already talked about valuations being maybe stretched.
I'm a bit of a skeptic that it can continue to go mm-hmm. the way it's going. I mean, I think there has to be some comeuppance at the end of this, just because, what I see out there is, again, back to these large aggregators that have taken, cash at incredibly high multiples. The way to think about what they're doing in the M&A space is averaging down that multiple. Because it's all just an arbitrage between what you took money at and what you're buying firms at. Mm-hmm. So if you took money at 25 times, you can turn around and pay 18 times for a practice. That doesn't seem to be good math to me, because I don't think those firms are likely worth 18 times. And look, I'm not smart enough to figure it all out, but that averaging down to me seems frothy, and it seems, fraught with a little bit of risk. So we'll see, but I'm skeptical the pace can continue the way it has.
Yeah. Changing gears just a little bit, you bring a lot to the table for these advisors that join you. That landscape is changing all the time too, right? Technology improves, new stuff happening all the time. I imagine AI is something that you guys are grappling with quite a bit. Where do you sit in terms of the technological evolution of wealthcare?
Well,
you started as a tech firm.
We're a little bit lucky because I actually have a development team, and I have, we have technology, and so we do consider ourselves to be out in front on some of that stuff. Mm-hmm. But in exactly the areas that you just mentioned, AI, and in particular, API integrations with some of these best-in-class providers in the space, that's where we're focusing, particularly next year. I think the use of AI, certainly in the advisor's practice, that's getting to be very mainstream, and we're working with firms like Jump to provide services like that to our advisors. So I think that will continue apace. The addition of agents in the back office, middle and back office, is something that we're looking at. I think that certainly is going to make a big improvement in our ability to continue to scale without adding headcount. Mm. But the other place that I'm looking at AI is as a small account solution for some of these advisors, to create more of a B2C type of solution for the advisors, where you can take your sub $250,000 unprofitable clients and put them into a channel that has all the attributes, the model management, the planning, all the attributes, but it's handled much more through an AI process. So we're starting to think about that for next year.
Can you bring something like the tax harvesting and that sort of thing down to that level of account with the technology?
I think that remains to be seen.
Okay.
When I think about, when I've looked at some of the tools in the marketplace, it certainly seems to accommodate our own investment solution. It has the planning element, the goals base, which is great, but I haven't seen the tax harvesting at that level.
Okay. Interesting. We're at this conference right now, and the conference is focused on growth, RIA Edge conference. Is there anything that you're hearing here in the hallways or on the stage that is resonating with you or surprises you, or something that you really?
Yeah, the first 3 or 4 sessions that were really focused on AI were eye-opening for me, and it's interesting to see how many different use cases advisors or these larger firms are employing, and so that's a lot to think about. But where I've really found that value here, and what I've kind of picked up in the hallway, is this whole idea of creating a true marketing lead gen process within your firm. And we're going to need help with this, because this is something that we know we want to deliver to the advisors that we recruit and that we buy. So I've had some interesting conversations with some of the firms that are on the cutting edge of email marketing, social media, lead gen, as well as execution of that process. So that's been interesting. The other thing is a great conversation with some of these providers of SMA crypto solutions. That's something that we're just dipping our toe into at Wealthcare. We've had some interest from advisors. We've found some groups that we're happy to work with. So that certainly seems to be top of mind for some of the advisors that are here at the conference.
Yeah, for sure. And this is driven by advisor interest and perhaps client interest.
Yeah.
This is not trying to foist crypto onto clients.
No, that's exactly right.
There's a from the level interest coming in.
That's exactly right.
Surprises me, but the marketing stuff is interesting to me too, because the organic growth obviously is what everyone looks to now. Without these kinds of marketing solutions that you're talking about, an integrated marketing platform of sorts, where does organic growth stand for you all? Do you keep your eyes on that? Is that something that you measure and base decisions off of?
It's one of the metrics that we track most close. So net flows to us is really key to our value proposition in the marketplace. Our thesis is loud and clear. If we get you out of the non-revenue generating stuff, then you should be able to grow. So historically, our advisors have grown 2 to 3 times the industry average. Now, admittedly, the industry average is anemic. Mm-hmm. Chip Rome will tell you it's 0. Yeah. I think it might be a little bit north of that, but not much. Okay. But our thesis is that if we are handling the stuff that you shouldn't be wasting your time on, then you should be able to grow your practice. And we've seen it, and we track it, and it's something that we consider to be key to our value proposition in the marketplace.
So you have to identify advisors that aren't going to say, thanks very much for taking all this off my plate. I'm going to go play golf. You want advisors that, thanks for taking off my plate. I'm going to double down on, find a new client.
I think there's always a place for a lifestyle practice. If the advisor has, some of these advisors have tremendous books of business and they're just not that interested in growing, and that's fine.
Yeah.
But if they are, we want to be sure we can help them.
Yeah. The integrated marketing platforms that you're looking for, you mentioned that some of the referral tools that are out there existing are ineffectual.
Mm-hmm.
Do you think that there's a solution waiting to be discovered in that space, or does it?
I should clarify that. I think that the tools are ineffective for the advisors that are doing it on their own.
Okay.
Or smaller advisors. What I think can be improved is if you create a truly integrated marketing solution that can take those leads or those introductions from these lead generation sources and then follow through with them. So set up meetings, using email marketing campaigns and AI, and you can really create something where those leads can be accessed, they can be vetted, and they can be passed along to the advisors in a very integrated way. So I think that's kind of the holy grail to that.
So maybe much the same way that you've developed a business development desk to find advisors and bring them in, maybe a sort of a business development desk of, the advisors no longer going out and making the connections and vetting the referrals and meeting folks on the golf course or whatever and bring them in. You have maybe a more institutionalized business development behind. So, okay, we found the client, now we hand it off to the advisor.
I think that's right. And look, it's running on a parallel track with the way that next generation of investors wants to interact. They don't necessarily want to be at a rubber chicken dinner sitting there listening to an advisor. They don't really want to get cold called. They want a digital experience. They want something where they can say, hey, this is what I'm interested in. Can you find somebody for me? So as that, type of interaction continues to grow, we want to make sure that we have something that we can, interact with that and perhaps drive organic growth for our advisors.
And might this be something you build in-house? I mean, you say you have developers in-house and you have your DNA as a tech company, but
everything that we look at as far as, our practice is do we buy it, do we build it, or do we rent it?
Mm-hmm.
And we have to make very smart decisions about when we're going to, build things ourselves, and when we can find best-in-class solutions in the marketplace and partners.
Mm-hmm. Mm-hmm. And that decision has not been made yet?
It's not.
Okay. All right. Well, it's fascinating. It's interesting. It's an exciting time, I think, for Wealthcare, right? I mean, it's you're on the cusp of an accelerated growth path.
We feel really good about it.
That's fantastic. Well, Matt, thanks very much for joining us on the RIA Edge podcast. I'll let you get back to the conference now.
Great.
And, we'll talk soon.
Great to talk.
Thank you.
A t-shirt and jeans, mac and cheese, oceans and sunsets. Some things in life are an obvious match, like RIAs and Schwab Advisor Services, the number one choice for independent advisors looking for a custodian who can help them go further. With all the wealth services, technology, and support an RIA firm needs, the difference is so obvious. It's Schwabvious. Find your match and learn why custody is just the beginning at schwabvious.com.